Good afternoon, ladies and gentlemen, and welcome. On behalf of all of our partners, colleagues, family, and friends of both BMO and Peerage Capital, we are thrilled to host another conversation with Doug Porter. Doug is a great friend, but he is a globally recognized thought leader in economics on a broad geographic basis. And we've had the privilege of having many conversations with him to discuss, economic implications of many different issues. Obviously, this is a privileged time to have with Doug in light of rising interest rates, high inflation, uncertain oil prices, geopolitical issues, the war in Ukraine, and many other issues that have affected market conditions. And so I think it's a real privilege to have you with us, Douglas. And I know the format's going to be, you're going to have a presentation, and then we'll go into a Q&A format. So Douglas, on behalf of all of us at Peerage and our partners and family and friends and colleagues, welcome. And it's really a pleasure to have you again with us this afternoon.
Well, thank you very much, Miles. Thanks for the kind introduction, and it's a pleasure to join you again today. And as you said, there is no shortage of items to talk about these days. I often like to tell people that I began my career with the Bank of Canada 40 years ago with the in Ottawa with the central bank. I don't tell you that to date myself. It's just that 1982 was a very important year because it was the last time that we saw double-digit inflation. That year also saw double-digit interest rates, and it saw double-digit unemployment. And I think the main point is that it was very painful to wring inflation out of the system back in the early 80s. And really that explains why the central banks are pushing on the brakes so hard right now, because they do not want to be in a situation where inflation gets so-called entrenched, and that we have to go through anything like we went through in the 70s and the early 80s. So turning to our the presentation, if I could just ask to have the deck put up now, please. If we can turn to the first slide for our audience. Turning to yes, the first one. So if we look at financial markets for this year, how they've fared in 2022. The vertical line on each one of the four financial markets basically shows the day that Russia invaded Ukraine. And first of all, I just want to step back and say that we were dealing with a very serious inflation issue even before the invasion. U.S. inflation was almost 8% in February. Canadian inflation was almost 6%. So the invasion, spiked up commodity prices. It made a bad situation worse, but that is not the root cause of our inflation problem. There are all kinds of different factors going on here that just added to the mix. In fact, many commodity prices are actually now lower than they were before the invasion began. For instance, even with a bit of a bounce in oil prices recently, they're still actually a little bit lower than they were before the day that Russia invaded. So that's really not the issue. But nevertheless, in response to that earlier run-up in commodity prices, we saw the central banks right around the world begin to raise interest rates. And the one interest rate you've got in front of there, the second panel, is the U.S. 10-year Treasury yield, which hit 4% today. Just to put that in perspective, before the invasion, it was about 2%. So we've had a doubling in this crucial long-term interest rate. And of course, many other interest rates have gone up by more than 2 percentage points. Meanwhile, we've got the U.S. dollar just steamrolling every currency in the world. Up until recently, the Canadian dollar had been holding up well, but even it has succumbed in recent days. And the reason why this is important is that every economy outside of the U.S. is dealing with just its own inflation pressures and a weak currency on top of it, which is, giving us a double whammy in places like Europe, Japan, and here in Canada of inflation pressures. And as a result of this, sharp run up in inflation, this weakness in currencies we're seeing globally, and the backup in interest rates, of course, it's been a brutal year for equity markets. A bear market in the S&P 500, not quite there yet in the TSX, but a very, very tough year overall for global equities. So what does this mean for the economy? If we turn to the next chart, please. And I'll focus on North America here. We about 3 weeks ago, we did tip into the official recession camp. I guess we're in the camp that's calling for a moderate recession. I don't think it's locked in stone that we're going to see a downturn. I think there actually is still a path through which we could escape an outright downturn. But unfortunately, I think there are also some odds that things could turn out to be a lot worse than the so-called mild recession that many are now predicting. Importantly, we're basically looking at no growth in Canada and the U.S. over the next year, with an outright decline in the first half of the year. I will point out, just looking a little bit backwards, this year will actually turn out to be a fairly strong year for the Canadian economy. We're going to end up with growth of above 3%. We still had the reopening play for the tourism and entertainment sector, and that gave us a pretty solid year overall for the Canadian economy this year. But that's basically water under the bridge. And when we look into next year, as I said, we are looking at fairly flat growth. Now, I have to tell you, this is a very unusual situation where you've got a number of mainstream economists like myself, essentially calling for a recession well before the time it's happened. Economists are famous for missing the turning points and actually starting to recognize that we're in a recession long after it began. This could be one of those rare occasions where economists are a little bit early, and the reason why so many economists like myself are now calling for it is it does go back to that very severe or aggressive rate hike that we've seen, series of rate hikes that we've seen just in the last 7 months or so. It usually takes about 12 to 18 months for rate increases to fully work their way through the economy. So we've got a lot of lead time here, and we've had this very, very intense rate hikes. Now, if we go to the next chart, please, let's drill down and look at how the Canadian consumer might fare. And frankly, there is a big push and a big pull here on the Canadian consumer. For much of the past year, we were pounding the drum on the so-called excess savings that people had built up during the pandemic. And not only did they have excess savings, but they had a lot of pent-up demand for travel and entertainment, and even things that they couldn't buy during the pandemic, like motor vehicles, for instance, were hard to come by. So this combination, we thought, was going to lead to a lot of support for the Canadian consumer. So what happened to those excess savings? Well, frankly, they're still there. Some of them have been eaten away by inflation. Some have morphed into investments, but we would assert that there's still, well over $100 billion that is likely to be spent sitting in bank accounts right now over the next couple of years. So we think that will provide some support for consumer spending. That's the good news. The less good news is household debt has come roaring back, partly driven by the housing boom in the last couple of years. People took on a lot of mortgage debt, of course, and we're now in a situation where household debt as a share of income is as high as it has ever been. Early in the stages of the pandemic, people actually paid down their credit card debt. We actually saw household debt drop in the first year or so of the pandemic, but then that quickly reversed, and we're now in a situation where the average household has $1.80 of debt for every dollar of disposable income. Now, on these figures, averages really do deceive, because the reality is only about 40% of the population has a serious amount of debt. Now, you may wonder, how can we be talking about excess savings and record levels of savings on the one side and be talking about record levels of debt on the other side? It seems like this is a real conundrum. Well, the straightforward answer is they're two different groups of people. We do have about 30 or 40% of people who are basically have amassed those savings, and then we have another 30 or 40% who account for the lion's share of that record debt. So there is a share of the population that will be squeezed by this very dramatic increase in interest rates that we've seen over the past year. But it isn't all going to happen at once. This is sort of like a process that will slowly develop over the next couple of years as mortgages come up for renewal. It won't bite all at once. There won't be, say, one specific time or tipping point that it will really begin to hit consumers. Now, if we turn to the next chart, one other source of support, or the next chart, please, is the job market. I think I've talked to this group before about just how incredibly fast the job market recovered, and I think this really caught policymakers by surprise. They were really generals fighting the last war, thinking it would take years and years to get the unemployment rate down. Instead, we basically went right back almost immediately to the extremely low jobless rates that we had before the pandemic, and this is true right around the world. That's not just a North American story. If you can see the figures on the right-hand side, you can see that almost every major economy has got a lower unemployment rate now than it had before the pandemic. Here in Canada, over the summer, we had unemployment rates that started with a 4 handle. We hadn't seen that since the early 1970s. In the U.S., their 3.5% unemployment rate is the lowest that we've seen, or tied for the lowest that we've seen since the late 1960s. And on top of that, we've got a mass of vacant jobs. In Canada, we've got almost 1 million job openings. In the States, we've still got over 10 million open jobs. Now, those numbers are starting to come down a little bit, but they're still extraordinarily high. And it's one of the reasons why we think even with a mild downturn in the economy, we're still probably looking at a relatively healthy unemployment rate in the next 18 months. We do see it backing up a little bit, but we certainly don't see it approaching anything close to recessions past. Our best guess is that the Canadian unemployment rate may hit 6.5% by late next year, and around 5% in the U.S. Higher than today, but by historical standards, still relatively tight job markets. If we turn to the next chart, I do want to touch on demographics here, because this is playing a role, and one of the reasons why there are so many labor shortages and why it's so tough to find workers, and why we think even in a recession the unemployment rate is not going to rise that much further. In Canada, we had the biggest baby boom of any major economy. I'm looking at births as a share of population back in the late 50s and early 60s. Now, there is no preset retirement age, of course, but the median retirement age is still 65. I'm sure everybody on this call knows somebody who retired earlier than that, or knows somebody who's still working well beyond 65, but the median age for retirement is still 65. And we've got this mass of people who were born in the late 50s, early 60s. The blue shading on the left-hand side, you can see how it stands out, the number of people born in those years, that are rapidly approaching that key 65 age. So if you think it's hard to find workers now, I think it's going to actually become more difficult in years ahead. Now, sheer numbers, it might improve because of very strong immigration totals, but I think on the skills side, we are really going to have a skills shortage in the years ahead. Now, turning to the right-hand chart, another big force at play is because of that strong immigration, we are actually looking at very robust population growth, some of the strongest population growth that we've seen in decades and decades. Yes, we did have a lull in 2020, but of course the federal government has tried to make up for lost ground, and they're looking at very aggressive immigration targets in the next few years. And ultimately this will fill some of the gap. But I'll tell you, it's not a panacea for the labor shortages that we're facing, because every new worker, every person who comes into this country, of course, carries demand with them. They need services, they need a place to live, they need healthcare and education. So they too bring with them demand. So it's not a panacea. Strong immigration is not going to immediately cure our labor shortage, and it certainly will not cure our skills shortage. Now, if we turn to the next chart, what do these things, when we put them together, mean for things like wages? Well, with a very tight job market, with 10 million open jobs in the U.S. and 1 million open jobs in Canada, that is putting upward pressure on wages. I actually read another well-known economist earlier this week said that there's no relationship between job vacancies and wages. I'm afraid there is. It's pretty clear that a big run-up in job vacancies leads wages by about a year, and we're starting to really see it in the U.S. where there's different measures of wages, but bottom line is the average American worker is seeing their pay go up by about 6 to 7%. In Canada, that they're now seeing their pay go up by about 4 to 5%. Those are strong numbers. Those are some of the strongest numbers we've seen in decades. But in both cases, they're trailing behind inflation. So on the one side, you've got one of the tightest job markets in a generation, and on the other side, you got wages that are actually trailing behind inflation. To me, that is a recipe for a lot of wage inflation over the next year, and a lot of labor market strife as well. And we're starting to see it. We came this close to having a nationwide rail strike in the U.S. a few weeks ago, and we're seeing the public sector unions, really agitating for much bigger pay gains. And I think this is just, frankly, I think it's the tip of the iceberg, and we're going to see a lot of strength in wage demands over the next year. So going to the next chart, what does that mean for the inflation outlook? Well, fundamentally, this is one of the reasons why we think even though inflation is going to come down in the next 18 months, we suspect it's going to even end next year relatively high. We're not as convinced as the market and the consensus that inflation is going to melt away quickly. There's a lot of information on this chart, but and I appreciate it might be a little bit hard to read. But a couple of key points are there's not that much difference between Canadian and U.S. inflation. We really can't separate ourselves that much from the U.S. Usually where the U.S. leads, we tend to follow. The last 30 years, Canada's inflation rate has been a little bit lower than the U.S. 30 years before that, ours tended to be a little bit higher. Over that whole 60-year period, the inflation rate has been almost identical in Canada and the U.S., with, of course, a lot of great variability in between. I think the other key point here is this is certainly not just a North American story. Every major economy in the world is dealing with this. In Europe, they've got inflation of basically 10% right now, very close in Britain. Even Japan, which has had no inflation for 30 years, has now got 3% inflation, which is high for them. The one economy that's a bit of an outlier here is China. And for a variety of reasons, their inflation is a bit more restrained. And the reason why that's important is it allows their government and policymakers to be going in the opposite direction of everybody else. They've actually been shaving interest rates this year and trying to support the economy, while almost every other economy in the world is really acting to depress spending and of course is busily cranking interest rates. Now for next year, we believe inflation is going to average about a little bit more than 5% in the U.S. after averaging 8% this year. In Canada, it has been a bit lower. Our wage and price pressures are a little less intense. But we're still looking at something close to 7% on average for inflation this year, and about 4.5% next year. So again, we really can't separate that much from the U.S. If we turn to the next chart, this table shows you what's driven inflation in Canada in the past year. A lot of information here. The main point on the right-hand side, these are the things that have gone up the most in price in the last 12 months. And I think my main message to you here is there are a lot of stories, a lot of different factors at play here. There is no one single thing that's driven inflation. There is no light switch that we can just turn off. Very, very briefly, I would say there are 5 big forces that have driven inflation. Very briefly, energy, the reopening, so we've had a bounce in things like airfares and hotel rates, some of the supply chain issues, which have led to shortages and pressure on things like appliance, furniture, and auto prices. The global food crisis, which has led to double-digit increases in grocery prices here in Canada and in the U.S., I'll point out. And finally, the housing boom, which has worked its way into the Canadian consumer price basket through real estate fees, new home prices, and rents. So that's 5 different things that we got to have stop going wrong or start going right over the next year to really bring down inflation. Now, if we turn to the next chart, one area where we do think we're going to get a bit of relief, and I appreciate this isn't necessarily great news for everyone on this call, is just the dramatic change we've seen in the housing market. We do think that this will offer some relief on inflation. The chart on the left looks at sales going back to the year 2000. It's monthly sales. These are seasonally adjusted, and you can see how off the charts we were during 2021 and early this year, and how that's gone, from a full-on seller's market to pretty much a buyer's market now. Not quite as extreme as the seller's market was 6 to 9 months ago, but it, clearly the balance has changed. It usually takes about 4 to 6 months for such a dramatic change to start to work its way into prices, but we are clearly starting to see prices retreat. The bar chart on the right looks at various cities, the change in price from this year's peak nationally. So prices peaked nationally in February, and this shows you how various cities have fared since that point. So the cities that have been hit the hardest have been Ottawa, Toronto, Hamilton, London, and Oakville. Now, what do those 5 cities have in common? They're all in Ontario. And clearly it's Ontario that had the biggest boom in recent years and is now looking at the most serious correction. Meanwhile, at the other end of the other extreme, the Prairie provinces really didn't boom that much in the last couple of years, and frankly, I think they have a stronger economic backdrop than southwestern Ontario does at this point. So I think the Prairies will actually hold up relatively well. Now, the conventional wisdom among Bay Street economists is that prices nationally will fall by 20 to 25%. I will tell you, we are probably part of that conventional wisdom. But I think what this bar chart tells you is how we can have extreme regional variations around that national number, and some cities are going to see something bigger than a 20 to 25% decline. In fact, it's not too hard to find a number of cities in southwestern Ontario, or at least outside of Toronto, that have already seen prices decline by 20% from their peak back in February. So that's really not that brave of a call at this point. The other thing I'd want to remind you of is prices in the first 2 years of the pandemic nationally rose by 52%. Just an extraordinary move in a 2-year period of time. If we turn to the next chart, please. In some ways, this hopefully you can read this a bit. Just very briefly, the chart on the left-hand side shows a long-run trend of real home prices in Canada, and you can see how far above the trend we got. The second chart basically just shows you the deviation from the trend, and we were as far away from that trend as at any point we've been in the last 40 years. It basically rivaled what we saw in the late 1980s, early 1990s. In terms of how far we got away, and finally the table on the right separates it down province by province in terms of how far away we got. And frankly, we were below trend in Alberta and Saskatchewan, just to give you a couple. But meanwhile, the smaller cities in Ontario got as far as 75% above their trend, and cottage country got about 65% above trend. And those areas I would say are probably most ripe for correction in this environment. And then as we go down the list, next down would be the GTA, and then Atlantic Canada, then Quebec, then BC, then Manitoba, and least susceptible to a correction would be Alberta and Saskatchewan. Turning to the next chart, please. And frankly, of course, a lot of this, how deep we fall, how long it stays down, really does depend on interest rates. Actually, I'll just jump ahead to the next chart in terms of our interest rate call. If we can go to the next one, please. In terms of the Bank of Canada, our view is that most of it has been done. We've seen the Bank of Canada raise rates by 3 percentage points, 300 basis points from the lows at the start of this year. We think the end is coming within sight, but Mr. Macklem has been pretty clear that we're not done yet. Our best guess is that they hike by another 0.5 percentage point at their next meeting in 2 weeks, and that they hike again in December by 1/4. Frankly, financial markets, partly as a result of today's frothy U.S. CPI, have priced in a little bit more risk, a wee bit more than that. Markets have maybe got another 1/4 point priced in at this point, but of course that pricing can change on a day-by-day basis. What I would say is I would sort of view ours as a floor. So we think the bank's overnight rate will rise by another 75 basis points. I sort of see that as almost a minimum. I think the risks of that call are that they do a little bit more than that. But we do believe that we're getting close to the peak on the overnight rate. Our view is that the Fed has to do a little bit more than that, especially with the outsized increases that we're seeing in underlying inflation in the U.S. We do believe the Fed will hike by 3/4 percentage point at their next move in early November. They go by another 0.5 point in December, and then they finish it off with a 1/4 point hike in the first meeting in 2023. Our view at this point is that rates will then stay flat through 2023 in both Canada and the U.S. Is it impossible that for the Fed to or the Bank of Canada to cut rates in 2023? It's not impossible. It's not our base case. But I think either everything has to go absolutely right on the inflation front to allow them to back off, or things have to go incredibly bad for the economy. And I'm talking financial crisis to get the Fed to actually cut rates in 2023. Our view is that they're going to stick to it until they really see inflation come back down towards the 3% area or even a little bit lower before they're going to be willing to back off on the rate front. And I think that's more of a 2024 story for when rates will start to come down. It is possible if we run into some kind of financial accident, like we saw in the UK in recent weeks, that they could nudge rates down 1/4 or 1/2 point in 2023 at some point. But a full-scale reversal, I think, would take some catastrophe for the economy to really get them to slash rates again, like we've seen in past cycles. I think the more likely case is that they crank them to a level and then they basically hold them through 2023 until they're really comfortable that inflation has cracked in a meaningful way. If we go to the next chart, please. Now, I think a fair question is, well, if you've got the Federal Reserve raising rates more than the Bank of Canada, doesn't that spell, real trouble for the Canadian dollar? Well, the answer is yes, it does, and that's really what's hit the Canadian dollar in the past month, because the market has shifted its view on this front. They've come around to this view that the Federal Reserve, the U.S. Central Bank, will have to hike interest rates more than the Bank of Canada. Up until about a month ago, the view was that the two would basically move almost in lockstep, and that's changed in the last month, partly because of the persistence that we're seeing on U.S. underlying inflation, whereas the Canadian underlying inflation has actually started to improve a little bit. So, the markets are coming around to the view that the Fed is going to have to do more than the Bank of Canada, and that has hit the currency, no two ways about it. Just to give you one little factoid, the Canadian dollar has actually weakened against the UK pound over the last 3 months. We've been even weaker than the UK pound over the past 3 months, and we're not alone on that front. By the way, all the commodity currencies have actually weakened against the UK pound. Now, this chart also has oil prices here in front of you, and I think that the key point here is the relationship between the Canadian dollar and oil prices has been blown to the wind. It just has not worked this year. That relationship began to weaken a few years ago, and this year it's just completely gone astray. There really is next to no relationship now between oil and the Canadian dollar. Now, there are many reasons for that. Some of them are domestic. More of this is a U.S. dollar story itself. As I said at the outset, the U.S. dollar is just running roughshod over everybody. We are by no means alone in this. The decline we've seen in the Canadian dollar over the past year, it's now down about 10% from a year ago. That's actually a lighter decline than most other currencies that we've seen globally. The Canadian dollar, actually up until very recently, the last month or 6 weeks or so, had been holding up relatively well against most other currencies. But this shift in view on the relative move between the Bank of Canada and the Federal Reserve has hit the Canadian dollar a little bit more directly in the past few months or so. Now, looking into 2023, our view is that the U.S. dollar is going to begin to lose some steam next year. We think as the markets see the end of Fed tightening, which, as I said, we think will start to come into view around the turn of the year, that's when we think the U.S. dollar is likely to crest and to begin to soften. But on balance, we're still looking at a relatively soft Canadian dollar, even with a bit of a comeback next year. Historically speaking, this is still a bit on the soft side. I think the other point of this chart, and it goes back to the year 2000, is even with the pullback we've seen in the Canadian dollar, the volatility in the last few years is nothing compared to what we saw back in the aughts. If you think back to 2002, we got as low as 62 cents at one point, and within 5 years, we were up to $1.07. So we saw a 45-cent move in the space of just 5 years at one point. Of course, it didn't last long at $1.07, but it gives you a sense of how volatile things used to be. Now I think we're closer to fair value. Personally, I think we're a bit below fair value in the sort of 72 to 73 cent range we've been in recently. I view longer-term fair value more in the 75 to 78 cent range. Now, if we turn to the last chart, or second last chart, just in terms of the recession risks. So ultimately, it does come down to whether inflation does back down. I mean, our view is inflation will recede in the next 18 months. But frankly, while this looks like a very dramatic decline in headline inflation in both Canada and the U.S. over the next year, we're actually above consensus. Our forecast for inflation is higher than the consensus, is higher than what the market expects over the next year. And so I think you're going to see periodic disappointments on the U.S. inflation front, much as we initially saw today. Nice rebound in the market today, by the way. But a month ago, the market was actually hammered quite hard by a high side U.S. CPI, and I think we're going to have to learn to live with a lot of volatility in markets over the next year, as there is going to be some periodic disappointment in the pace at which U.S. inflation does come down. The other point to make here, and the thing I'll conclude on, is that by the end of next year, even with this fairly marked decline in inflation, we're still going to be stuck with headline inflation in the neighborhood of 3.5% to 4% at the end of next year. Keep in mind the central bank's target inflation at 2%. They're okay with a range of between 1 to 3. 3.5 is still a bit too hot for comfort, and effectively, that's why we think rate cuts are really a 2024 story and not a 2023 story. I hope I'm wrong on this front. I hope that inflation does come down faster than this, but I think we've all learned in the last 18 months to be cautious and not to assume the worst, but prepare for bad news on the inflation front, because I do think it's going to be sticky, and a lot of it goes back to that wage story I talked about earlier. That's it for the forum part of my remarks, Miles. I'd be happy to take questions or just to have a discussion now. Anyways,
thank you very much. This is really helpful. We have lots to cover. Let's start with inflation. It's went from, in the last 12 months, we had people believing that maybe it was transitory. Now it's anything but transitory. So why did the Fed get it wrong? And why have they had to harden their foot on the pedal on rates so aggressively? Could they have done something that could have started earlier and been less dramatic. And so what did everybody miss?
In a nutshell, I think there were a lot of mistakes made, but I think maybe the most important was just the supply side story, and that's what's really differentiated this situation. So we had this enormous amount of stimulus thrown at consumers, whether it was through low interest rates, quantitative easing, fiscal support of all kinds. People's income didn't even blink during the recession. The average U.S. and Canadian consumer, actually, their disposable income actually went up in the recession. And meanwhile, they were channeled into only so many things they could buy. You couldn't buy services. There were a lot of goods that were in short supply. The supply chain just got completely stressed. And so, you have on the one side people wanting to spend and a limited things they could spend on. And I think this was a very unique situation that, frankly, the Fed and other central banks fumbled. When was the mistake made? I think it was made in the second half of last year. I mean, to me, around the summer and early fall, it was pretty obvious that the U.S. economy had reopened. It was well on the road to recovery. The unemployment rate was coming down pretty aggressively, and inflation was proving to be very sticky, and commodity prices and energy prices were proving to be very sticky. And Powell really stuck to it. He stuck to his transitory story, and I think the mistake was made in the second half of last year. And then I don't want to get too political, but I would point out that he wasn't reconfirmed as Fed chairman until November of 2021. And it's almost like as soon as he was reconfirmed, it's like his messaging changed almost instantaneously, and I don't want to believe it, but I think that's what happened, that he stayed dovish, supporting the economy as much as he could until he was reconfirmed, and then suddenly the world changed. The Bank of Canada has come under a lot of criticism by many fronts, some pretty well known. The one thing I would point out is I personally think the bank got it earlier than other central banks. They started backing off on quantitative easing a whole lot earlier than others did. They were actually warning about rates going up earlier than others were. They were one of the first central banks to start hiking. They were one of the first to hike rates by 50. They were the first to hike by 100 basis points. They've been as aggressive as anybody. And that, by the way, that's one of the reasons why Canadian inflation is a wee bit lower than in some other major economies. I'm not going to tell you they got everything right, but they didn't. But I will give them some credit for being a little bit faster off the mark and understanding what they were up against earlier than other central banks. So I think it's a little unfair, some of the criticism they're taking. And I would also go back to that story that Canada can only deviate so much from the U.S. on the inflation front. We can only do so much better than they can. But in going back, I think what really caught people by surprise was partly how quickly spending recovered, how willing people were to get back out and spend, and they underappreciated the supply side issues.
So we're talking about inflation with a target that they talked about of 2%. We're nowhere near that now, and as you said, we're probably 3.5%, 4% by the end of next year. How long do you think it takes, based upon macro and micro factors as you see them, till we get back to a 2% interest rate, a 2% inflation rate?
So if things go well, it is possible we could be at 2% by 2024. That's not impossible. We would need things like the supply chain issues to largely go away, and by the way, they're in the process of going away. We would need commodity prices, I think, to calm down, energy prices especially, but food prices, we need some help on that front too. There are some encouraging signs there, even with OPEC's aggressive move. Oil prices at a 1 week bounce, they've stabilized. Pretty soon oil prices are going to be basically where they were a year ago, and so its impact on inflation will fade if they don't sprint higher again, and the same goes for food prices as well. The thing I'm concerned about, though, is this has become less a story about goods inflation. It's more a story about services inflation, and that's a tougher nut to crack. And that, by the way, that's what we saw in the U.S. CPI today. We actually saw a decline in gasoline prices. We saw a decline in used car prices. We saw a decline in clothing and drug prices in that month. And yet we still had a pretty hefty rise in CPI. What's going on here? It's all the service sector. It's things like rents and the way they measure housing in the U.S., airfares, hospital fees, all those sorts of things saw one of the biggest increases that we've seen in 40 years in the last month. So it really has become a services story. And the issue there is wages. And as I mentioned in my piece, we probably got more upward pressure on wages here rather than downward pressure. And unfortunately, what it's going to take to really crack that is probably a rise in unemployment over the next year to help moderate wage pressures. This is not going to be a painless process. It's going to be tough over the next year. I do think it does probably require at least a moderate recession to really tame inflation pressures. Having said all that, I personally believe the central banks are dead serious about controlling inflation, and if it takes a more meaningful downturn, I think they'll take that medicine. It's going to be tough sledding, but I do believe we're ultimately going to get to 2% inflation. Now, the thing that might be different when we emerge from all this is before the pandemic, central banks were actually having a hard time getting inflation up to 2%. I think the world has changed. Now it's going to be more of a challenge to get it down to 2%. And one factor that's changed in the last 5 years is globalization has gone from being a real tailwind, helping keep inflation low, to now being a bit of a headwind and pushing inflation up a bit. As I'm not saying we've deglobalized. It's just not the help that it used to be before the pandemic.
Is there any difference in the challenges that Canada faces to tame inflation versus America, or are we basically attached at the hip, the same issues that affect Canada affect the States and vice versa?
Yeah, very big picture. We're largely joined at the hip, but we can certainly do better. And we have been doing a little bit better for a variety of reasons. Even the way the consumer price basket is put together, especially on the housing side, is quite different between Canada and the U.S. And healthcare services take up, naturally, because of the way healthcare is funded between the two countries, takes up a much bigger share of the consumer price basket. I would say on both those fronts, both those areas are seeing a lot of pressure in U.S. inflation. I'd say that actually helps Canada relative to the U.S. The way housing is measured in Canada, it will affect the CPI a lot faster here than in the U.S. And so the pullback that we've seen in the housing sector will actually will seek to dampen inflation faster here than it will in the U.S. And of course, healthcare services are almost a non-factor in the way we calculate inflation in Canada. So that's the good news. The one bad news, and I touched on it a bit in my piece, is this recent deep drop in the Canadian dollar. A 10% decline in the Canadian dollar in the past year is going to aggravate or frustrate Canada's inflation fight a bit. It almost immediately affects things like food and gasoline prices, and then it slowly works its way into other imported goods a little bit later on. So that actually gives us a bit more of a challenge. And in a way, it's almost like the U.S. is exporting its inflation problem to the rest of the world through a strong U.S. dollar. So that does make it tougher for us to really deviate that much from the U.S.
Explain, people have asked me this question a bunch. I'm not in as good a position to answer it as you are. Explain how a recession impacts consumer behavior and corporate investment in capital goods for the short and long term.
Yeah, and there's really two ways through which monetary tightening can work. Some of it is very direct. When you think of a consumer who's taken on a mortgage, maybe a variable mortgage rate, or their 5-year rate has come up, there's the direct effect of actually having to pay higher interest, and that squeezes that squeezes the amount that they can spend on discretionary goods or even some necessities as well. That's the very direct effect. The indirect effect is the broader channel through which it dampens growth. It tends to cut employment, or the amount that people profits that they can earn through their work or through their small business. And just the general slowdown in the economy can act as a dampener on consumer behavior. It also, when you're faced in the nightly news or going online and reading about recession downturn, it does tend to make people a little bit more cautious, and they might be more cautious in a big ticket spending item. Now, I personally believe that most people respond to what stares them right in the face in terms of what they're earning, what their own bank balance tells them. that's really the biggest driver of consumer spending is what's going on with their own income. But it can be somewhat shaded by by what they read and hear in the news as well. On the corporate side, of course they're largely responding to consumer behavior. Business investment is actually one of the last things to turn in a cycle. It tends to boom at the very end of a strong uptrend, and when the cycle turns over, business investment is actually one of the last things to roll over. Because it's really the responding to how consumers are behaving, how they're spending, and what they're seeing in their own export order book. So business investment will really ultimately respond to how consumers behave. But of course, business people are well, yes, they're human too, and of course they're reading the news and they're listening to folks like me and what we're calling for the economy. I'm not saying they're going to adjust their behavior just on what I or others might say, but they'll take it into account. And if every economist is talking about a recession, naturally they can restrain their behavior as well, and they might become a little bit more restrained in terms of what they're willing to do on capital spending. And by the way, that's one of the reasons why we're very careful about throwing out the R word. We don't take it lightly at all. We certainly don't want to feed the pessimism. We only start talking about it when we think it's, the risks have gone well above 50% before we would start talking those ways. We do not throw that word around lightly.
So interest rates, you and I have been around enough time. When I started business in 1980, interest rates went from 11 to 22%. When I look at, Fed fund rates, going to 4.5% or whatever they're forecasting, maybe even it goes to 5%. In light of where rates have been for 25 years, that's not such a draconian result. Why has it caused such pandemonium and fear and anxiety in the markets? And because in the large scheme of things, over a long term of history, that hasn't been so onerous. Is it because we got very comfortable with virtually no rates, like low rates for so long? Or is it reading into something else? Because as I said, the history books show you 5% Fed funds rate is not an onerous level.
You're absolutely bang on, and arguably, when you think about it, as I said, U.S. inflation today is 8%, and even underlying inflation is well over 6%. So a Fed funds rate, of 3, 4, 5% actually is quite modest. And if you're very logical, if your wage is going up by 5 or 6%, it's really not that punishing to borrow at 3 or 4 or 5%. I would say, having said that, to your other point, yes, the market, whether it's the real estate market, the equity market, or even the market for baseball cards or fine wine, basically got priced at interest rates pretty close to zero. Or in fairness, when you look at Canadian mortgage rates, they were still in the ones a year ago. You could get a 5-year mortgage rate in with a 1 handle on it last October still. And unfortunately, a lot of asset prices got based on those kind of interest rates. So the level matters, but so too does the rate of change. And frankly, if we went back to the start of the year, I doubt there was really a serious forecaster out there who was calling for the Fed to raise rates by 3 percentage points or more in this year. We were certainly looking at rate hikes this year, but we weren't in that league. And some of it was the messaging we were hearing from the Fed. I just thought they were, that they were going to tolerate this kind of inflation for a long period of time before they got serious, and it turned out they were serious a lot faster than we believe. But to answer your question, it's both the level and the rate of change that matters for markets and asset prices.
If you looked out 3 years, say by the end of 2025, based upon reasonable sets of assumptions with what you could see, what do you think Fed funds rates is by the end of 2025 in 3 years?
So I can give you our official call. We think that they will begin to back off and move rates closer to neutral through 24 and 25, because I think we will go through a period of very, very slow growth, and we think inflation will moderate over the next 2 to 3 years. As I said, it's not going to be painless, but we are assuming that the Fed will do enough to bring inflation down. And in that environment, if they get it eventually right, even if we have to go through a recession, we think they'll ultimately take Fed funds down to what I would consider to be neutral, which for me is in the range of about 2 to 2.5%. So
Now,
not that far from where we are today.
So for those of us who are not economists, when you say neutral, does that mean that interest rates will reflect inflation? So if inflation is 3%, rates will be 3%, or is there some other description that you would tell us?
I think the very general way of thinking in neutral is that they're sort of in their long run average, what we expect over say the next 10 or 20 years, and are neither really depressing growth nor they adding to it. And it just so happens that would be fairly close to what they target for inflation. I personally believe that those short-term rates have to be a little bit above where they're aiming to get in inflation. Prior to the pandemic, I mentioned that they were actually having trouble getting inflation up. I actually thought neutral in Canada was below 2%. And if you think back to the last cycle, just prior to 2020, the Bank of Canada got their overnight rate up to 1.75%, and that proved to be a little bit too high for comfort. That was actually cooling the economy. 1.75% was acting as a depressant, and the Fed got their Fed funds rate up to about 2.5%, and that was cooling the U.S. economy. So that seemed to actually be in restrictive territory, and they had to back off. A lot of people have forgotten the Fed was actually easing well before the pandemic because, they had tightened just a little bit too much in 2018, and they had to actually back off. I think so. They were finding neutral was actually around 1.75 or even lower. I think neutral's gone up a bit since then, but it to me it's still in that sort of around 2.5% range. That's my best guess at this point.
As an economist, how concerned are you about the rise in interest rates and its effect on government cost of funding deficit? No one was worried about the deficit. Well, rates were virtually zero. They've gone up dramatically. I forget the number, but I think for every 100 basis points move in interest rates, it costs the U.S. government, I don't know, $100 billion or something like that. Is that a big concern of yours with high interest rates on such a huge deficit and a growing deficit? In both in Canada and the United States, for that matter.
Bottom line is yes. I think this is a concern, and I apologize for not putting a fiscal chart in my package. I usually do, but in the interest of time, I didn't include a fiscal chart. I actually think that after we've slayed the inflation beast, after we've moved on, I personally believe that government finances are going to be the next big thing that markets are going to come back to worrying about. We haven't really worried about those in a long time, and I think this is a story for 3 to 4 to 5 years down the road. We've got to squeeze inflation out of the system first, but I think that's going to be the next big concern. Now, here in Canada, we're a little bit more fortunate. We're in somewhat better shape. I don't think we should pat ourselves on the back that much. We're not, in a different world from everybody else by any means, but we are a little bit stronger than certainly most other G7 economies. You can find lots of advanced economies that are a bit better than us. Just name a few: Sweden, Korea, Australia. But generally speaking, we are a little bit better than average. I used to joke that it's like we're the best looking horse in the glue factory. We are certainly in better shape. The federal government actually ran the biggest surplus they've ever run in the first quarter of the fiscal year. Their fiscal year begins in April. So in the spring quarter, they ran a surplus of $10 billion. I don't think it's going to last. I think we're still going to have a fairly sizable deficit for Ottawa this year. But I will give them some credit. I think they've looked at what just happened in the UK. They're looking at the inflation pressures. They're doing very modest things so far to support the consumer. I know they were lashed a couple weeks ago when they brought out their GST rebate, but in the greater scheme of things, that was a very small amount of money. I don't think it's really not going to move the needle on the inflation front. And so far they've been very restrained on that front. Meanwhile, at the provincial level, it's almost like the pandemic didn't happen in provincial finances. All kinds of provinces, including Ontario, ran budget surpluses last year. Did much better than expected. And the bottom line here is, in the short term, inflation actually helps government revenues because it boosts up. Government finances boosts revenues immediately, and meanwhile, spending, it takes time before it really adjusts to inflation, and the interest rate bite comes a little bit later. that's the good news. Inflation first pumps up government finances. Later, though, when you have to deal with inflation, when you got to crank up interest rates, when the economy slows, that's when the pain shows up more. When you think back to the terrible recession we had in the early 80s, and then we were left with a real fiscal problem in the mid 80s, and that dragged on in the 1990s, that was the carry through from the inflation fight that really showed up in government finances later on. Now, I don't want to depress you, because I don't think the situation is nearly as serious as it was back in those episodes. But I do, to your point, I think this is going to be the issue, especially in places like the U.S. and Europe, after they've slayed the inflation dragon.
Oil. We've seen, big volatility over the last couple of years. It was below zero, I think, at one point.
Yep.
Where do you see, are we at a fairly reasonable rate? Do you see $80 as being a stable number? Could it go higher, lower? And what is the implication to Canada? Is oil, or how tied is our GDP to a higher or lower oil price?
It's almost become it really does not affect Canadian GDP that much anymore. That's not to say it's not an important part of the Alberta economy. Of course it is, but the reality is we have limited pipeline capacity. ESG considerations mean that there's only so much capital spending that'll get done. Basically, we're on maintenance mode in terms of oil and gas, especially oil production. We're still one of the largest producers in the world. But I think oil production is likely to remain relatively stable for years to come. And the oil sands are basically a manufacturing process. The investment has been done. As I said, there's limited capacity to get it out of the province. And so I think we've basically capped out in terms of production, but I think it's going to be stable. Now, when oil prices go up, that really supports government revenues, especially in Alberta, and it supports incomes in Alberta. But it doesn't lead to a lot of new capital spending or employment like it would have in the past because of ESG considerations. The last thing I'll say is just in terms of the prices, I think OPEC's decision to aggressively cut production last week was a real signal that they want to see a floor on oil prices. I don't know what the exact number is, but I think when it got below 85, they're very uncomfortable, and I think they're going to defend it, and they can. And so I would assume that we have to brace ourselves for relatively high oil prices for a period. That's not to say they're going to sprint higher from here, but it's tough to really see them collapsing with OPEC so committed to maintaining that floor.
So in light of everything that's gone on, the S&P 500 as of yesterday was down 25% during the year from the high. Today we had a bit of a rally, so we're down 23%. Stanley Druckenmiller was on Squawk Box, so I don't know, a month ago, and he said I could see 10 years of basically flat, market performance. Do you have a commentary on what you think next year and the next few years look like? Obviously, we've eradicated a great deal of value in 401ks and that kind of RSP value. Where do you see the markets over the next 1 to 3 years?
So first of all, going back to Mr. Druckenmiller's comment, of course, the market is never stable for long periods of time. If it really believes we're going to have terrible returns for 10 years, that a lot of that will get priced in almost immediately, or in the next 6 months or so. We never just float along nicely. It tends, of course, to go bounce back and forth between extremes. I wouldn't be quite that bearish. I think what we've seen in the last year is a readjustment, and we touched on this earlier. Basically, asset prices got priced at a certain level of interest rates. We've had a bit of an interest rate shock in the last 9 months that the markets had to reprice to. I think that is largely in there now. I think the market is priced to this new interest rate reality. For me, the issue in the next year is and I think it's prepared for some softness in the U.S. economy. I don't think it's really built in a full scale recession. So I'd still be playing defense a little bit here because it's adjusted the rates. It hasn't completely adjusted, to a bit of a challenging near term economic environment. Longer term, I'd be a little bit more bullish because I happen to believe that the central banks will win this battle, that inflation will recede and interest rates will back off a bit. It could take time. It could take, as I said, it could take some economic pain in the next year to get there, but ultimately I do believe they'll be successful. And so I tend to be a little bit more positive or constructive than Mr. Druckenmiller over the medium term.
A lot of people on the call are from the real estate market. There's been a profound impact on real estate over the last 4 to 6 months. Talk about your views. I mean, the mortgage rates in the United States hit, I think, almost 6.9% today. Where do you see housing in particular? You know, as you said, it's down in Ontario around 20%. So when there was articles saying that we could see a 23% drop, that was perceived as extremely draconian. But prices, do you see prices firming up and getting stronger in 23 and 24? And where are the areas of real estate that you have the greatest confidence in, and where are the areas you have the greatest concern about?
So very, very briefly, I think, you know, the market's still adjusting to the rate move, and as I said, I don't think we're completely finished on that front, but you know, it's coming within sight at least. So I think there's still a little bit more of an adjustment to go, much like the equity market, you know, in terms of fully pricing in what's happening on the rate front. In terms of a deeper decline, I think it really does depend on how, you know, how mild or non-mild any kind of downturn we need to wring inflation out of the system. Our view is that the unemployment rate is not going to rise enough to seriously affect the housing market, but there is a risk that the Bank of Canada has to do more, and that the unemployment rate is going to rise even further, and that could lead to another down leg in prices in 2023 if it does come to that. That's not our base case view, but I'd see that as being the risk. So in other words, the bank has to do more than what we expect, and we get more economic weakness than expected. I'd you know, and I know, you know, this is not going to be a popular view on this call. I'd still be cautious on the real estate market for the next year. You know, until we see inflation meaningfully coming down, and we know that the Bank of Canada can start to, you know, relax its grip a bit, I think you still got to play defense here a bit on the real estate market. Now, to your point there, you know, and I made this point earlier, there's lots of different stories going on here. That's a very broad item. I would be a bit more constructive on the GTA, and especially Toronto proper. I don't believe it got as frothy as some of the suburbs and outlying cities. You know, I'm from London, Ontario originally. London, Ontario prices went nowhere for 30 years, and then suddenly they tripled, you know, in a matter of years. A lot of that was just investment pouring in. And, you know, we saw that throughout Southwestern Ontario, you know, up and down the 401. London was just one of many cities that saw that same behavior. And I think at the end, they really did overshoot, and they're susceptible to a very severe correction. I don't think that's really the case in Toronto. You can make the case that, you know, it's got a very different dynamic than a lot of the smaller centers in Ontario. So I'd be a bit more constructive on Toronto longer term or medium term. You know, I'm often asked about the population story, and certainly the kind of immigration numbers we're looking at in the next few years will provide support over the medium term. But I think over the next year, that gets dominated by the rate outlook and what happens to unemployment. I think those dominate the population growth story.
Are you still expecting 400,000 or 500,000 new immigrants coming to Canada, about a third coming to Ontario?
That's Ottawa's goal, and they've tended to hit their targets. You know, if not even exceed them in some years. So the bottom line is yes. And if anything, you know, the new Quebec government is signaled that it actually wants to cut back on immigration, not to zero or anything, but they want, you know, something in the neighborhood of 40 to 50% for a province that still accounts for, you know, almost a quarter of the population. So that could ultimately mean that even more come to places like Ontario, BC, and Alberta in the years ahead.
Douglas, I know that you have a time constraint. I wanted to articulate our gratitude and appreciation for your fantastic insights. It's very valuable all the time, but at this time of uncertainty and all of the different variables affecting economic, prosperity across North America and globally, they're very valuable. On behalf of BMO and Peerage and all of our colleagues, partners, family, and friends, thank you very much. We look forward to doing this again at some point in time in the future. It probably won't be another time this year. So I wish everybody a healthy, happy, sweet, and prosperous new year and all the very best for the festive season. Thanks very much for your time and thanks for engaging with us. And we look forward to seeing you again soon. Have a great evening.
Take care, everyone. Bye now.
Take care.